Do you think Elon Musk will come bail out Block shareholders from Jack Dorsey like he did with Twitter? Talk about that and more on today's show. What is going on, investors? Hopefully, guys are doing well out there. Time to kick off another big earnings day, where we had a lot of payment stocks, including Block, formerly known as Square. The ticker symbol is still SQ. The company reported their Q3 earnings, which came in pretty nicely, okay? $4.52 billion. When we come over here to the financials, we'll show you the revenue. We'll show you the all-important cost with this company, because the revenue growth is still, it's not impressive anymore with this company. Just 17% growth year over year. When we come over here and look at the earnings expectations or the revenue expectations for this company, it's kind of a mid-teens grower, maybe even a high teens grower for the foreseeable future. Certainly gone are the days of 30, 40, 50% growth on this one, but gone are the massive market caps over at this one. I remember when this one was over $100 billion company. Now you got a $35 billion market cap on this one. Certainly come over here and look at it from a technical perspective. It's actually setting up kind of interesting, hitting two areas of resistance. We'll see if Block is able to power through there. Certainly if you're bullish on this name, you need it to power through the levels that it's at now over the next couple of days. Let's jump into these Q3 earnings. $4.52 billion. That was 17% year over year growth for the most part. When we roll through these numbers, they were fantastic. Their Cash App, their Square payment processing network, just absolutely killing it, absolutely crushing it. But the thing that we always have a problem with this company, and it's still a problem, is they are not minting money over at this company. And one of the reasons why is they just continue to increase their operating expenses quarter over quarter. Now, they didn't give us formal guidance for the upcoming quarter, so we'll have to assume Wall Street estimates for the upcoming quarter at $4.66 billion, which is just fractionally up from the quarter that we just had at $4.52 billion. I suppose there's an outside chance you maybe get to $4.75 billion, but basically you're going to go up another, we'll call it $200 to $300 million on the upside when it comes to revenue for the upcoming fourth quarter. Now, the company, though, is already telegraphing that their non-GAAP operating expenses are expected to go up over $206 million to nearly $1.5 billion for the next quarter. So any revenue gains that we have sequentially from the third quarter to the fourth quarter are likely going to be chewed up by increases in those operating expenses. We'll see more evidence of it when we dive into these Q3 numbers. Here's that $4.5 billion worth of revenue. What I like about this company is they have multiple business units, and they're actually their fastest growing business unit is their highest margin business. That's why, as long as this subscription and service-based revenue, as long as that growth rate continues, well, at some point, you'd think this company would probably start minting some profits at some point. But as we walk through this, you'll see that they actually don't. Transaction-based revenue coming in just a shade over $1.5 billion. They have about $900 million worth of cost there. Here's the beautiful business line here, your subscription, your Cash App. It went from $694 million worth of revenue last year, almost doubled, to $1.2 billion. Not quite a double, but it's still impressive growth rate there. And the reason why we focus on that is look at your cost, okay? They went from just $128 million to $225 million. So you only had to spend $225 million to earn $1.2 billion. That gives you like nearly $1 billion worth of gross profit. The hardware revenue, that's a loss leader. They essentially give the hardware away for free, or they're essentially selling it at a loss. They spent $76 million on hardware to earn just $43 million. That's typical in this business. And then finally, you have the Bitcoin revenue, which we've gone over many times here on the channel, is an extraordinarily low margin business, but obviously contributes to the other areas, their Cash App, and kind of makes it a complete app from a crypto and a stock and a savings perspective. Off of $1.76 billion worth of revenue, they had about $1.23 billion worth of cost over there. So that really gooses up and juices up your revenue line. But the most of that Bitcoin revenue is they're just being a middleman over at Square, just kind of catching a small percentage in between those transactions. So off of $4.5 billion worth of revenue, we had total costs coming in at $2.95 billion. That gave us gross profit of over $1.57 billion. That's really, really nice. But unfortunately, with a lot of Jack Dorsey-led companies, we saw this with Twitter for not a short period of time. We saw this over the history of Twitter. And the reason why that stock languished until Elon Musk and his investor groups just simply bailed it out is the fact that your operating expenses just continue to grow over here. Product development up to 548, sales and marketing to 485, up from 409. I expect when your sales are going up, even if it's a small degree, just 17% year over year, I'm going to expect sales and marketing to go up. I'm going to expect product and development to go up. I don't mind them reinvesting for the future. Here's the problem with this company is you have the general and administrative line went from 267 all the way up to $395 million. You added over $130 million of just G&A cost over the last year. And that's important for this company. $130 million is not a rounding error when it comes to their revenue and certainly their gross profit. It's basically 10% of their gross profit. The other thing that I noticed is they had more transaction and loan and receivable losses over the last year. In fact, up dramatically from 62 million all the way up to 147. So they've got a lot more credit risk with that buy now, pay later business. And also they're loaning money, I believe, to merchants and maybe even consumers as well. This company is absorbing a lot more credit risk. Again, up from 62 million last year all the way up to 147. We'll have to see in subsequent quarter if that can start to plateau or if this is a number that we're just going to continue to see rise, particularly probably related to that buy now, pay later business. So your total operating expenses in the most recent quarter came in at $1.615 billion last year. They were at $1.1 billion. So you take this $1.57 billion worth of gross profit and you minus off 1.6 and you get to an operating loss of about $49 million. This is the problem we always had with Twitter. This is the problem we've always had with this company in particular is it's just run at just a break even. So yes, they have some really positive things. They have positive earnings momentum. They have really positive things going on with their product, particularly Cash App, but they burn through all of it when it comes to running the company. So yes, if you work for this company, it's good. Yes, if you're an executive like Jack Dorsey, you're making a lot of money, but the shareholder is down 78% over the last year. Year to date, down 67%. Even over the last 6 months, this stock is down 47%. It just isn't good enough. From a shareholder perspective, you lost 2 cents per diluted share. It seems the best that Block can do is put up a quarter where they basically break even from a rounding perspective. And then at worst, they lose 40, 50, 60, 70 million dollars. They just don't put up that quarter after quarter where they make $100 million, $200 million, $300 million off of $4.5 billion. They just can't do it. And I still think that's a problem with this company. But from a financial perspective, they can more than afford to do this. When we get down to cash flows, you'll see more evidence of that. They have plenty of cash on the balance sheet. They have some liabilities, okay, over $12 billion worth of liabilities, $4 billion, a little over $4 billion worth of long-term debt, but they have more than that in cash. So this company doing a nice job from a balance sheet perspective. When you come down here to cash flows, it typically painted a pretty good story because you have excessive share-based compensation. We've got a 9-month cash flow chart over here. We pulled down a net income number of $435 million last year when the stock was much higher, over 78% higher. They actually had positive net income of $240 million. So we've really gone in the wrong direction over here. And look at your share-based compensation. This year, $795 million worth of share-based compensation. Last year, obviously, when the stock was a little bit higher, they didn't have to issue as much. They lost about $430 million due to share-based compensation. You get all your add backs and your subtractions, including depreciation, amortization, up considerably this year. And you get to add back in transaction and loan losses, which look like they've tripled over the last year. Look at your transaction and loan losses last year at 130 through 9 months. You're up to $395 million. Yeah, that's a triple. So this company's probably going to have to maneuver their algorithm or however they're deciding to make these loans. They're really seeing a lot of losses there. So you get your net cash provided by your operating activities. Guys, you get to add things like these loan losses and the share-based compensation in, and you still didn't improve your operating cash flows year over year. You went down from 653 million last year, all the way down to just $130 million with a positive cash flow through 9 months. Give them credit for another, 50 million in the next quarter, maybe. And you're at $180 million worth of positive cash flows. Yes, the stock is down big over the last year to the tune of 78%, but you still got a $35 billion market cap on a company that's not profitable from an operating perspective, not profitable from a net income perspective, not profitable from an earnings per share basis, and just churning out just $130 million worth of positive cash flow over the last 9 months. It's just still not good enough. Now, it's not the company's fault. It's not Jack Dorsey's fault that shareholders are bidding this thing up still to a $35 billion valuation. But with all the declines that we've seen in the stock market, this certainly is not what I would call a screaming hot value. Not quite yet. Everything else looks about the same as what you'd expect with this company over the last year. It looks like they redeemed some convertible notes, maybe with straight cash of over $1 billion. Guess those note holders may not have wanted the stock given the performance of it and given the performance of Jack Dorsey in the past leading these types of companies. When you come down here, now I know I've kind of eviscerated from a financial perspective, but look, they still have a fantastic product. This Cash App over the last year just continues to accelerate year over year on this subscription and service-based revenue. It's a high margin business. So if you believe in this one in the longer term, that is certainly something that will benefit in the future. Certainly something that could grow into profits if this company can eventually rein in those operating expenses. Now, the market's not agreeing with me. They're loving this in the after hours, although obviously when your stock is down this much, a lot of bad news is priced into the stock. During the regular session, stock was down about 1.34%. In the after hours, we're seeing this thing up 13%. It is hitting its head. We have multi-year support down here at about $59 per share. In the after hours, we're trading at about 61. So it has peaked its head over the $59 level. And again, these bars are not in here super accurate. I would say the stock is basically trading at a resistance level. You'd really want to see it get well over and above that. It bounced off another natural area of support, this kind of thinner purple line that I put down here at about $53 per share. That's about where the stock was today. I put in a fake green candle here to show you the price action. We're basically right here. So we're really hitting our head against two areas of resistance. First of all, this purple line, which again was support for the longest time for the stock back in 2019 and early 2020, right at $61 per share. You also have this lower trend line. These channel lines have just been locking stocks. Whenever they get to these channel lines, they might peek their head over them for like an instant or two, but almost every stock that we're looking at is getting fat rejected at these spots. We'll see if that's the case with Block. You'd really want it to get up, probably up $69, $70 per share. If you're able to do that, man, the next stop of immediate resistance probably up close to $80 per share on this one. If you like this one, if you believe that Jack Dorsey will finally run a company that will spit out profits and not just excessive stock-based compensation for the executives and the employees, well, this is where I would accumulate this stock, anywhere down where it was today at 54 up to maybe the middle of the channel at a $65, $70 per share. I think you can accumulate this stock if you believe that. I don't have confidence in Jack Dorsey. I never saw it with Twitter. He never turned that company into a cash flow generating machine. It was very lucrative for the employees, very lucrative for the executives, but it was a terrible investment, especially over the longer term for shareholders, unless you got it at the screaming hot valuation that it once traded at. That's why I'd be even more patient with this company. I think there's some headwinds coming. If that growth rate stalls on that Cash App business, well, all of a sudden this stock would shed off even more of its market cap. And on top of that, I don't necessarily see this stock making this quick V-shaped recovery back into the $100 range, which would put you at a $60 billion valuation on a company, again, that is not profitable from any metrics, and even the growth rate doesn't really warrant an excessive valuation either. That's just my opinion on Block. I'd love to hear your opinion down below. Hopefully you guys have a wonderful day out there, and good luck with your investments.